Hello, this is Joe Pryor of the virtualrealestateteam.com in Oklahoma City, a part of Redbud Realty and Associates. And today is part 6 of our I.N.V.E.S.T series, Investing in Oklahoma City Real Estate, and the last letter is T, and T stands for taxes. So we've defined what we try to do in Oklahoma City: long-term investments, conservative, good, positive cash flow. So we're making money, and when you make money on something, typically you pay taxes. But in the case of Oklahoma City, in the case of real estate in general, the federal government, the IRS, gives us a break on our taxes when it comes to investment, and that is called depreciation. So let's take a typical investment that you might make here. Let's say that it's $100,000 for the house, total in is what you put into it. We have $300 a month of positive cash flow going for us. Do we pay taxes on that $300? Well, when we talk about depreciation in a residential home, we're talking about the improvements only. Land does not appreciate. You can always put something else on there and it doesn't have any loss. But in the case of improvements, it can. So what we do is we take the improvements and we separate that out from the total purchase. So one of the ways that we can verify this, where the IRS will accept it, is from your appraisal, where they separate out the land value to the improvements value, or even going into the county courthouse records where they do the same thing. So let's say that it's 15%. Let's say the land is valued at $15,000. Well, now we have an $85,000 depreciation that is stretched out over 27.5 years. In the case of residential, it's longer in commercial. And then what we do is we take that 27.5, divide it into the 85,000, and then divide it by 12, which is our monthly depreciation. Now, to get technical, there is a difference in the first year and the last year, but for the purposes of this video, we're just going to say divide by 27.5 and by 12. So now that $300 is positive cash flow, but we also now have $257 a month that we're depreciating out. So you can see that what we might pay taxes on that passive income is quite a bit less. And then of course we can take certain things like expense. So let's say, for instance, in a particular year we want to replace the roof. Let's say that roof cost $5,000 of our own money to replace. Well, that is something that can be expensed off your investment within that year, combined with depreciation, and you don't have any kind of taxes to pay that year. Now, let's say that your loss is greater than what your taxable event would be. Let's say we take a loss in that year because of some capital improvement like a roof. Well, we can carry that forward into the next year. So you get some very, very nice tax breaks when it comes to investing in real estate, because you have that cash flow coming in. That's money you could spend if you wanted to, and then you can pretty well offset it with depreciation in most cases. So this is a real advantage over other types of investments that you might make that do not have that you do not have ready use of that money, like we talked about before, of reinvesting it into another home, putting it into an interest-bearing account, something that extends the return on investment that you're getting on the home. So another reason to invest in real estate in Oklahoma City is the fact that we have positive cash flow that's to a great extent offset by depreciation. So in our final series of this, which is a summary of everything, I'm going to go into taxes when we get out of an investment. In this last summary at the end, what I'm going to talk about is what's going to happen if we cash out. What's going to happen if we want to do a 1031 tax-deferred exchange and buy more property? We'll talk about those taxable events and kind of put it up in a neat bow about where you want to be in 10, 20, or 30 years from now. This is Joe Pryor of the virtualrealestateteam.com in Oklahoma City, where we deliver traditional real estate values at the speed of technology.